Traders at UBA said they expect a tight liquidity in the Treasury bills market as investors continue to remain on the sell side. Kenneth Onuoha, team member, Assets and Liabilities at UBA, joins us now for more market movements. Kenneth, thank you for joining us today. Let's get right to it. Let's start with market trading action today. Start with the Treasury bills market.
Thank you, Esther, for having me. Like you rightly point out, the Treasury bills market has been one that has been deeply affected by the depressed liquidity state and the system liquidity. What we did see is that we've seen traders are predominantly on the sell side. They're trying to generate liquidity as a result of the repo-driven net system liquidity that we have. Long and short, what we are currently seeing in the market right now is essentially sales across, offers rather, across the curve, typically along the February 21 and 6th of March bill.
All right. Talk to us about liquidity levels. Are we going to see any improvement in the coming week?
In the contrast to what we saw last week, where system liquidity was quite elevated, we have seen severe depressions in the liquidity states. Now, Monday, system liquidity opened at about 89 billion credits. However, this has further depressed to levels as low as 1.419 as at this morning. This is largely due to, of course, market color shows that this is largely due to a combination of CRR debits, FX sale settlements, and as well as NMPC debits. Now, what we are seeing is there is increased activity in the SLF space. We've seen SLF figures read as high as 1.5 trillion as at this morning. Are we expecting some form of respite to the system? Next week, we hope to see about 500 billion hit the system. About 166 should come from NTB maturities, and about over 450 something billion should come from the settlement of OMO maturities as well. So yes, that should come and give some level of respite to the system. But considering where we are and what it feels like a drop in the ocean.
Right. Let's talk about the MPC meeting this week. I know investors have their eyes on that. Talk to us about what expectations are. We've seen, obviously, yields on the high side, the Treasury bills market as high as, effective yield 26%. But it looks like the government, the sovereign, is sending signals that there is going a pullback happening because obviously these high yields, these high rates have debt service implications for the fiscal authorities. But talk to us about what investors are expecting, still seeing inflation elevated above, of course, a real rate of return.
So the signs are there for all of us to see. The bond calendar for Q3 was issued on Tuesday, and as opposed to the 450 billion spread across the three tenor buckets or maturities that we tend to see, we saw it reduce, a reduction in size issuance to 120 billion. So clearly the appetite from the government is obviously reducing, and that would translate into the expectations in terms of the borrowings. We expect that rates should obviously not go beyond what it closed at the last auction. From the bond side, we saw it close at about 21.5. For the 2033s, and then we saw the NTB auction close at 20.68. In line with the current trend, we expect that the rates will obviously begin to taper down in the second half of the year.
But will subscription levels remain high, even with rates tapering down? Will investors demand more to hold on to these government securities?
As much as we expect that investors would want to invest or increase, the subscriptions levels will go high. It is a function of how much liquidity in the system and how the rates actually, what the stop rates print at. So if the stop rates print at favorable yields, of course we would see FPIs coming to, especially if OMO is being floated. But that's again function of where liquidity plays out in the coming weeks. Right.
Just a last question. I'm sure you saw it in the news. International money transfer operators now having access to the official market. That's the official FX market. What are your thoughts in terms of how this could potentially improve liquidity at the market?
If there's one thing that we're certain about, it's the fact that the the CBN is genuinely focused on causing this form of price stability, the Naira stability basically. We have seen several reforms during the course of the year, and this current reform, of course, it will increase general investor confidence, and we would begin to see traction in that regard.
All right, Kenneth, we'll leave it there. Thank you so much for talking to us today. Have a great weekend.